Screens flicker green across a trading floor while futures tick higher and algorithms redraw risk in microseconds. Not a victory lap, but a countdown to a decision that moves trillions by a quarter point. Not certainty, but probability hardening into price as the Federal Reserve steps onto center stage and the market leans forward to hear a single verb: cut or hold. Here is the promise. By the end of this briefing, you will have a practical map for how a Fed rate cut ripples through Nasdaq tech, reshapes AI valuations, and opens or closes the financing spigot for data centers so you can decide what to own, what to hedge, and what to avoid. If that's the map you need, share this with one operator who needs it and tell me in the comments which constraint hits you hardest. Yesterday's world crowned duration without question. When money was near free, the far future felt close. The discount rate was a whisper, and every ambitious roadmap won the benefit of time. Today's world prices time again. Cash flow next year outranks a story 5 years out. Capital has a carrying cost. Covenants have teeth, and the spread between profitable platforms and pre-profit aspirants widens with every basis point. The old frame asked, who can grow fast? The new frame asks, who can compound returns at their actual cost of capital? In AI, that difference is decisive. GPU clusters turn from a trophy to a mortgage the moment rates spike. 3 constraints set the physics of this move. First, the discount rate itself. When the Fed cuts, the rate used to translate tomorrow's dollars into today's value falls, inflating long-duration assets companies whose cash flows are far in the future. In plain language, a lower rate means future profits count more right now, lifting multiples for growth names most of all. Second, credit transmission. Cheaper base rates do nothing if lenders keep spreads wide or terms tight. The impact depends on how fast banks, private credit, and bond buyers reopen windows for issuance. This controls the queue time between policy and balance sheets. Third, asset intensity. AI infrastructure is steel, silicon, power contracts, and leases. Data centers are financed like energy projects with long lives and heavy upfront spend. Weighted average cost of capital, your blended rate across debt and equity, sets the hurdle. A lower hurdle turns maybe into go. A higher one turns go into later. Amplifiers can add thrust or drag. Forward guidance multiplies the effect. If the cut is framed as the first in a path, one and done language mutes duration. If HEAL yields, nominal yields, minus inflation expectations, validando the tailwind to growth strengthens. If they hold firm, the lift is smaller. Credit conditions amplify when debt markets accept longer maturities and looser maintenance tests. They dampen when buyers demand cash sweeps and step-up coupons that claw back the benefit. Fiscal headlines can push to accelerated depreciation for data center gear or grid incentives lowers effective capital cost. Tighter permitting on transmission can stall projects regardless of rates. Equity flows matter last mile. When generalist capital rotates into tech funds and passive vehicles, the multiples expand faster. When redemptions force sales, the rally stutters. Now the hinges, the decisions that bend the curve for operators and investors. Decide your exposure to duration with intent. If the cut looks like the start of a cycle, extend into quality growth with visible unit economics. If it's a pause before inflation noise, stay closer to profitable compound. Failure mode is chasing beta in names with no path to cash generation. Decide your financing mix for compute. Lock long-dated fixed-rate project debt for data centers while windows are open. Avoid floating stacks that turn earnings into a rate bet. Failure mode is interest expense outrunning pricing power. Decide your build sequence. prioritize power-secured campuses before land-only options. Megawatts beat map pins when funding tightens. Failure mode is stranded sites with no interconnect. Decide your AI pricing architecture. Index portions of enterprise contracts to capacity costs so margins hold as financing shifts. Pure fixed price promises crack when the cost curve refuses to cooperate. Failure mode is selling compute below its all-in cost. Decide your supplier covenants. Negotiate take-or-pay with flexibility bands and price escalators tied to energy and capital markets. Rigid terms win headlines and lose cycles when reality bites. Failure mode is paying penalties while utilization lags. First-order choices cascade into second-order realities. If duration rallies, equity becomes cheaper currency and stock-funded acquisitions reappear. The acquirers with credible cash engines buy R&D at a discount. If credit windows widen, GPU landlords go from beggars to choosers, and campus developers capture economics once kept by hype. If rates fall but power remains scarce, megawatts become the new rent and interconnection queues become the new discount rate. A memorable line for this tape. Kilowatts set the cap on valuation. Basis points set the speed of a rating. Another way to say it, financing lowers the fence. Power opens the gate. You can see patterns on the map in clear first names with consistent free cash flow. A cut pulls forward buyback and capex plans, tightening float while scaling capacity into known demand. The stock trades like a duration barbell growth plus cash discipline. In unprofitable platform stories with real network effects, the lift depends on access to term debt or converts. Those who term out liabilities at lower fixed rates can extend runway without diluting holders, while those stuck in floating debt remain hostage to every dot plot wobble. In data center REITs and private developers, lower rates boost net asset values and reduce capitalization rates, but only in markets with signed power purchase agreements and interconnect rights. Sites with permits, but no power still where a maybe later tag. In semiconductor capital equipment, a cut accelerates orders if it coincides with capacity expansions financed on project debt. If backlogs are already full, the re-rating shows up in multi-year guides more than next quarter's units. Honest limits belong in view. A single cut rarely fixes tight power markets or long transformer-led times. Financing may be ready while electrons are not. Inflation that proves stubborn can cap the Fed's path and keep real yields sticky, lifting cash costs for everyone even as the headline rate falls. An AI spending pause at a few flagship customers can flatten the slope for suppliers even in a friendlier rate world, and valuation gravity still applies. Multiples that overshoot on the first pop are the first to compress if guidance arrives thin. Rate sensitivity is a lever, not a moat, delivering out the playbook that turns macro into moves. Start by defining what good means in metrics you control. Cash conversion cycle under stress scenarios. Interest coverage at current and -1% rate. Return on invested capital for each build versus your weighted average cost of capital. Keep definitions plain. WACC is the blended rate you pay across debt and equity. If a project's expected return does not beat it by a margin, do not build. Do the megawatt math equivalent with 3 blunt questions before you commit. How many megawatts are actually energized this year? How many dollars per kilowatt will you lock at fixed terms? And how many months of runway do you gain if your interest expense drops by they cut your modeling? Those answers forecast your real runway more than any narrative. Choose architecture by basin and segment, not by slide, in power-rich basins with stable rates. Prioritize high-density clusters, where cooling and grid stability support aggressive utilization. In constrained basins, favor modular expansions with quick-turn leases that scale with demand. Treat schedulers like traders. Move the heaviest training jobs into off-peak windows to harvest cheaper energy, and align capex draw schedules with known financing windows. Build a latency quality portfolio across AI offerings. Local inferencing for latency-sensitive workloads that reduces your cloud bill. Edge-catching categories and centralized training on contracted capacity with predictable pricing. Route easy workloads to efficient models. Short context, quantized weights. Retrieval over brute force and save premium compute for jobs that actually warrant it. Escalate only when needed and measure details. P95 and P99 are the bad day percentiles. The performance you can hold on 90, 5 or 90 out of 100 runs. Design promises around the tail, not the mean. Co-invest in shared infrastructure that buys durable license and lower cost of capital. A joint substation or transmission upgrade shared across campuses can unlock megawatts cheaper than isolated builds, and the market rewards predictable power more than extra land. Use treasury discipline like a product. Ladder maturities pre-hedge a portion of expected issuance and keep dry powder for windows when spreads compress. In sales, make pricing elastic to capacity cost. Include clauses that float with energy inputs or offer volume 4/8 swaps that align customer demand with your financing cadence. In procurement, security core ship agreements for GPUs with flex bands that protect downside without capping upside. Your worst contract is one that forces idle supply or caps profitable scale. Observability turns stories into steering. Instrument utilization at the rack and cluster level. Tie revenue per kilowatt to leave dashboards. Track cost per trained token and cost per served token so teams see the real price of quality. Publish an internal basis point sensitivity sheet. Show how a 25, 50, or 75 basis point move shifts your interest, your project, IRS, and your acceptable customer discounts. When everyone speaks basis points and megawatts in the same breath, execution accelerates. And when the cut lands, run post-mortems in days, not quarters. What moved in spreads, what reopened in issuance, what filled in the deal calendar, which names caught real bids versus headline pops. Risk management is offense, not just defense. Hedge a slice of your interest exposure through swaps, while optionality is cheap. Do not overhedge into a cycle that may continue easing. Keep underwriting discipline on acquisitions, even as your stock becomes stronger currency. Stock-rich deals only work if the target's cash engine improves your WACC. Model A cut, then stall case, where the Fed trims once and waits. In that world, assume valuation excitement fades and unit economics must carry the day. Plan to be fine at the lower multiple. Investor positioning follows from these mechanics. Quality compounders with net cash and pricing power usually re-rate first and hold gains longest. They fund capex internally and add leverage only on their terms. Profit-light platform names rally hard into the cut, then sort themselves by access and discipline. Those who term out or raise at tolerable dilution extend runway. Those who rely on variable lines trade like options on the next print. Data center landlords tied to real interconnects and pre-sold capacity capture the compression in cap rates. Land banks without electrons stay theoretical. Semiconductor capital names follow the order book. If financing translates into purchased orders, the guidance expands. If customers front-run the cycle already, patience pays more than chasing. Recap the principles. When the Fed cuts, time gets cheaper, but power stays scarce. When duration rallies, cash still wins the tie. When financing opens, architecture decides who can use it. Measure the tail, not the mean, because stress makes or breaks margins. Buy the bottleneck power interconnects. Trend tokens, not the press release. Translate basis points into megawatts before you sign. Now you have the map for a rate cut tape that could reprice tech, reset AI valuations, and either unfreeze or supercharge data center financing, where duration helps, where cash still rules, and where power quietly sets the ceiling. If this helped, follow and subscribe. Then tell me in one tight line which single constraint or decision you want unpacked next, so we can make the next brief even more surgical.